In a market that is supposed to move on balance sheets, interest rates, and supply curves, silver just printed a contradiction so sharp it deserves a second look. In the first 6 trading days of February 2026, roughly $430 million poured into the world's largest silver exchange-traded fund. That alone is a headline. But it happened while the metal was still reeling from a record one-day collapse of 27% on January 30th, 2026. Those two facts are not supposed to sit together. A market does not usually attract that much demand at the same time it is experiencing that kind of mechanical stress. This wasn't a slow burn either. Not months, not weeks. In 48 hours, the market flipped from euphoria to forced liquidation and back to stubborn demand. For years, the standard refrain was that a silver squeeze in the modern era could never really happen. Too much liquidity, too much inventory, too many professional players. But that argument quietly assumes the paper system can always absorb stress without changing its rules. And the paper system just changed its rules. The uncomfortable part is what happens before most people even notice. Institutions do not wait for a trending topic. They watch the plumbing. They watch clearinghouse policy updates, collateral schedules, deliverable inventory categories, and the spread between what is promised on paper and what can be delivered without friction. By the time the public sees the story, institutions have usually already adapted. That's not cynicism. That's how risk management works. So instead of chasing a price target, let's follow the trail of numbers that don't match. Because when two parts of a market tell opposite stories, the resolution tends to be dramatic. Welcome to Silver Ledger, the place where we decode market mechanics before they become dinner table headlines. If you value calm analysis that follows data rather than mood, consider subscribing the way you'd keep listening to the wise elder who never raises their voice. And drop a comment with where you're watching from, because local currency conditions change how people experience the same global shock. Now, here is what actually happened. In order. Late January 2026 was already tense. Silver had recently surged into triple-digit territory, briefly trading above $100 per ounce before sliding back under 80. That kind of move doesn't happen in a vacuum. It pulls in momentum traders. It pulls in hedgers. It pulls in speculative leverage. It also pressures anyone who is structurally short, whether through futures, options, or complex spread books that rely on the assumption that volatility remains within historical boundaries. Then the market received a quiet but crucial adjustment. Effective January 13, 2026, the primary futures clearing system for precious metals shifted from margins set as fixed dollar amounts to margins expressed as a percentage of notional value. In plain language, the collateral you must post is now tied directly to the dollar value of your position. When price rises, margin rises automatically. When volatility rises, the percentage requirement can rise too. That combination turns collateral into a moving target. If you're fully funded and conservative, you barely notice. If you're leveraged, you feel it immediately. Because a notional-based margin regime does one thing exceptionally well. It forces leverage out faster during big moves. It doesn't matter if your thesis is right. It matters whether you can carry the position through the collateral storm. On January 30th, 2026, the storm arrived. Silver recorded a historic one-day drop of 27%. That is the kind of move that detonates risk limits, triggers forced selling, and compels desks to reduce exposure simply to survive. And in the days that followed, margin requirements were reported to be increased repeatedly, with changes tied to January 30th, February 2nd, and February 6th. You don't raise margins in quick succession in a calm market. You raise them when the system is trying to defend itself. Now, here is where the story refuses to behave like a clean collapse. On January 30th itself, even as the price was falling in record fashion, more than $100 million still flowed into the biggest silver ETF. Over the first 6 trading days of February, total inflows reached roughly $430 million. This is the part most people miss. A market can crash because participants choose to sell, or it can crash because participants are forced to sell. The flow data suggests that while one layer was being forced out, another layer was stepping in. That creates a central mystery. Who is being forced out, and who is willing to absorb it? To answer, we need to place today's episode in its historical frame, because silver has a long memory. The actors change, but the market's stress responses rhyme. In 1980, the silver market experienced a famous spike and collapse. The story often gets summarized as speculation and then a crash, but the more instructive detail is the policy response. As prices rose, exchanges raised margin requirements and tightened rules that forced leveraged positions to unwind, which accelerated the reversal. The outcome was that the cost of maintaining paper exposure became prohibitive, and the reversal punished those who could not meet changing collateral demands. In 2011, a similar rhythm appeared. Silver advanced rapidly into the public imagination. Then, as volatility spiked, margins were increased repeatedly in a short window. But what really happened was the market repriced leverage. Many participants who wanted exposure could not afford the collateral requirements, so they exited. Meanwhile, the underlying industrial and investment narratives did not disappear overnight. The market simply forced a reset in who could stay positioned. Now, in 2026, the same broad pattern is visible, but with modern engineering. Instead of a series of ad hoc fixed margin hikes, the system has moved to notional-based margins. Instead of only retail excitement, there is evidence of institutional awareness in the way policy shifts and volatility responses are clustered. Instead of a single straight-line move, there is a violent reset that tests who can stay in the game. Here is the key historical lesson. When silver squeezes, it often squeezes the financial structure first. The metal is the headline, but the squeeze is on the balance sheets that carry paper claims. Now let's talk about the institutions involved, because this episode is not about villains. It's about incentives and roles. Start with a clearinghouse and exchange infrastructure. Their priority is system stability. They ensure contracts settle. They ensure defaults do not cascade. When volatility explodes, they raise the cost of participation through margins. This protects the system, but it also changes the market's short-term trajectory by forcing liquidation of positions that cannot meet the new requirements. Next is the futures trading ecosystem itself. Large participants often run books with thousands of contracts across multiple maturities. They hedge, they arbitrate, they provide liquidity. But liquidity is conditional. It is abundant when volatility is predictable. It withdraws when volatility threatens capital. When margins rise and price gaps, even sophisticated desks reduce exposure, not because they suddenly hate silver, but because their risk models demand it. Then you have the ETF structure. An ETF is a bridge between capital markets and bullion markets. When investors buy shares, authorized participants create shares, and that process typically results in metal being sourced and allocated somewhere in the chain. The mechanics can be complex, but the directional signal is clear. Persistent inflows into the biggest silver ETF during a period of violent price declines imply that some participants are choosing a vehicle that is not as margin sensitive as futures. Then you have the London Vault system. At the end of January 2026, London Vault data reported 27,729 tons of silver. That number matters for perception because it sounds enormous. It is enormous. But what matters for stress is not just total stock. It is whether stock is increasing or decreasing, and how much of it is available for the flows demanded by market structures. 3% month over month. A 0.3% decline sounds small until you remember the base is massive. Small percentages in large reservoirs represent meaningful tonnage. Now add the COMEX warehouse system. Here, the vocabulary hides the signal. Eligible metal meets specifications, but is not committed to delivery. Registered metal is in the deliverable category for future settlement. A large total inventory can exist while the deliverable layer tightens. When the deliverable layer tightens, the market becomes more sensitive to delivery pressure. 26 million ounces from registered. That doesn't prove an immediate shortage. It does prove motion in the layer that matters most for settlement. It is a directional hint that some participants prefer metal leaving the deliverable bucket when the paper market is under stress. Now, place these signals side by side, and you can see the dislocation forming. On the paper side, the market is behaving like a stressed credit system. Price swings are extreme. Collateral requirements are rising. Participation becomes more expensive in real time. Leveraged positions are forced to shrink. That can create sharp declines that look like the end of a story. On the physical linked side, the market is behaving like demand remains active. A massive ETF receives hundreds of millions in new inflows during and after a historic crash. London Vault totals remain high, but trend slightly lower. COMEX registered stocks show notable reductions on key days. Meanwhile, industry reporting highlighted that silver broke above $100 in January. The gold to silver ratio fell below 50, and then the market snapped back, with silver finding support under 80. Zero earns its name. The squeeze is not simply a retail chant. It is a stress event where paper claims are being repriced against the friction of physical availability and the cost of carrying exposure. Now let's ground this with evidence in a clean sequence, because the details matter. First, the flow evidence. Over $430 million into one silver ETF in 6 trading days is a statement. It says that despite volatility, capital still sought exposure. And the single-day inflow of more than $100 million on January 30th, the day of the record drop, says something even stronger. It says that at least one major constituency saw the crash not as a reason to leave, but as an opportunity to enter through a vehicle less vulnerable to margin shocks. Second, the margin evidence. A shift to percentage of notional margins effective January 13th changes the entire behavior of leverage during large moves. Under fixed margins, a trader might plan collateral with a stable schedule. Under notional margins, a price spike automatically expands collateral needs. If volatility spikes too, the required percentage can rise. That creates a compounding effect that can force liquidation even if price later rebounds. This is why big moves can create bigger counter moves. Third, the cadence of margin hikes reported for January 30th, February 2nd, and February 6th indicates the clearing system perceived persistent risk. A single margin hike might be routine. Multiple rapid hikes say volatility exceeded expectations repeatedly. That tends to trap participants. They reduce positions after the drop, then price rebounds, then margins rise again, and the cycle drains liquidity. Fourth, the inventory movement evidence. London Vault totals at 27,729 tons are a major reference point, and the slight decline is a trend flag. COMEX warehouse outflows, especially in registered, are a settlement flag. When registered declines during periods of paper stress, it suggests the deliverable pool is not expanding to relieve pressure. That is how dislocations persist. Now, what does this mean going forward if the pattern holds? It means the metal may not be the only thing under pressure. The market is also pressuring the capacity to pretend supply is infinitely elastic through paper instruments. When leverage is cheap, paper supply feels endless. When leverage becomes expensive, paper supply feels scarce. That shift can happen quickly. And it often happens at the worst possible time for those who rely on paper abundance. This is also why a squeeze can look like a failure before it looks like a resolution. In many historical episodes, the market's first response to stress is to make participation harder. Higher margins force liquidation. Price drops. The crowd declares the story dead. But the underlying demand doesn't necessarily vanish. It just changes form, and it waits for the next imbalance. So let's make the mechanism simple without dumbing it down. Think of the futures market as a highway system. Leverage is the speed. When the road is clear, cars can go fast. When a storm hits, the highway authority lowers the speed limit and demands heavier safety measures. A margin hike is the safety measure. It requires each driver to carry more weight in the trunk before being allowed on the road. Some drivers can do it, others cannot. The ones who cannot must exit immediately. That sudden exit is forced selling. Now add the notional-based margin regime. It is like a rule that says the faster your car, the heavier the required safety gear becomes automatically. When price rises, the notional value rises, and the required collateral rises, even if the risk percentage stays constant. During volatility, the percentage can also rise. So the gear gets heavier twice. That makes high-speed participation fragile. It can turn a rally into a liquidation event in hours. In that environment, participants who want exposure but do not want margin sensitivity tend to seek other vehicles. That is one reason ETF inflows become such a revealing indicator during futures stress. It is not that ETFs are magical. It is that their buyers are not forced to post more collateral overnight because of a volatility spike. They can hold through the storm more easily. Now, step back and consider why the paper versus physical dislocation cannot last forever. If physical availability is genuinely abundant and flexible, the stress should ease. Inventories would rise, deliverable categories would stabilize, and price would calm as the market absorbs demand smoothly. But if physical availability is tight at the margin, the paper market's attempts to flush leverage do not eliminate demand. They simply delay it, reroute it, and potentially concentrate it in fewer, stronger hands. Historically, this kind of setup resolves in one of three ways. One, it resolves through time and exhaustion. Volatility declines, margins stabilize, and the market rebuilds. This is the slow path. It often leaves many participants frustrated because nothing dramatic happens after the drama. Two, it resolves through repeated bursts. Price surges as demand reasserts, margins tighten, forced selling hits, and then demand returns. This is the sawtooth path. It is painful for leverage and emotionally exhausting for everyone watching a chart. Three, it resolves through a confidence break in synthetic supply. This is the rare path, but it is the one that produces the sharpest repricing. It can show up through unusual term structure behavior, stress in leasing and borrowing, delivery anomalies, or rapid declines in the deliverable pool. And when market participants stop assuming paper claims can always be rolled without friction, they begin paying more for certainty. And certainty in commodities often means metal. Notice what I did not do. I did not give you a guaranteed number. I did not say silver must do anything. Because the point is not prediction. The point is recognizing the stress signals that historically precede major shifts. So what should be watched right now? Watch margin communications and how frequently they change. Rapid changes imply ongoing stress. Watch whether ETF creation remains persistent during drawdowns, because that indicates demand that does not flinch at volatility. Watch London Vault trends month over month, not because the total will vanish overnight, but because direction tells you whether metal is being drawn or replenished. Watch COMEX registered categories specifically, because deliverable metal is where settlement pressure shows first. And watch the contradictions. When the public narrative says the move is over but inflows remain strong, that is a contradiction. When paper price collapses while deliverable categories draw down, that is a contradiction. When a market needs repeated margin hikes to remain stable, that is a contradiction. Contradictions are where major moves are born, because they force the system to choose which reality will dominate. Now we arrive at the divide that always forms. Some people watch price and treat it as the whole truth. They see the 27% collapse and assume the story ended. Others watch mechanics. They ask whether the collapse was voluntary or collateral driven. They ask why more than $100 million flowed into an ETF on the very day of the crash. They ask why margins were tightened repeatedly in days. They ask what it means when registered ounces move out while volatility is flushing paper exposure. This isn't about being smarter. It's about paying attention to the right layer. Markets create wealth gaps by creating information gaps. Institutions watch the plumbing and adjust first. Retail watches the headlines and reacts last. That is not a moral criticism. It is a structural fact. Zero has already begun. It will not announce itself with a single clean candle or a single viral clip. It will reveal itself the way all commodity stress reveals itself. Through repeated strain in the settlement system, through divergences between paper behavior and physical linked indicators, and through the quiet, almost boring policy changes that alter who can stay positioned through volatility. This is Silver Ledger, where we decode what matters before its headlines. If this analysis connected dots you hadn't seen lined up, you know what to do. Because the question is not whether the market will remain calm. The question is whether the mechanics keep tightening while demand keeps showing up, and who is still standing when the system finally chooses which side is real. There's another historical echo worth remembering, because it shows how quickly paper calm can flip when stress hits the real economy. In 2008, silver sold off during the first liquidity scramble. Cash was king, and anything that could be sold was sold. But once the forced selling phase passed, silver rebounded sharply as central banks expanded. Policies and investors reassessed what protection meant. The first move was a balance sheet event. The second move was a repricing of confidence. And if you want a more recent template, look at 2020. During the early pandemic shock, markets experienced a rush for dollars. Commodities and precious metals were not immune. Yet that stress exposed a truth. There is a difference between owning exposure and being able to access it when the system is strained. Spreads widened, logistics mattered, and the cost of immediacy rose. When immediacy becomes expensive, paper and physical stop tracking. That is why the seemingly boring details, like the classification of ounces as eligible or registered, can matter more than a chart pattern. Eligible metal can sit in a warehouse and still be unavailable to settle a contract because it is not committed. Registered metal is the pool that can satisfy delivery without renegotiation. When registered shrinks, the market can still function, but it becomes more sensitive to demand and less forgiving. At the same time, London Vault totals can look comforting while availability is constrained by ownership, allocation status, and the pace at which metal can be mobilized. A vault can hold metal that is already spoken for. A headline number can be large while the movable float is small. It is a reminder that inventory is not the same as supply. Supply is inventory that is willing and able to move at the posted price. So when you see an ETF attract massive inflows during a crash, treat it as a behavioral signal. It says someone prefers exposure that can be held without nightly collateral calls. When you see margins repeatedly tightened, treat it as a structural signal. It says the system is defending itself against volatility. And when you see deliverable categories drawing down, treat it as a settlement signal. It says the layer that matters at the moment of truth is moving.